Corruption Exposed, Episode 1, Part 2. The One Big Beautiful Bill. What was actually inside in Part 1? We looked at how the Tax Cuts and Jobs Act was portrayed to the American public, the branding, the messaging, the emotional language used to sell it as a win for working Americans. Now let's pull back the curtain. Because inside that beautiful bill was one of the most sweeping redistributions of wealth in modern U.S. history, and most Americans never read a word of it. The Tax Cuts and Jobs Act was more than 500 pages long. And while it did include some short-term benefits for middle-income earners, the overwhelming bulk of the legislation served one master: corporate America. Let's start with the headline item: the corporate tax rate. Prior to the bill's passage, corporations in the U.S. were taxed at a statutory rate of 35%, one of the highest in the developed world. But almost no major company actually paid that rate. Between loopholes, deductions, and offshoring, the effective tax rate was far lower, often under 20%. Still, the TCJA permanently slashed the statutory corporate rate from 35% to 21%. That's a 40% reduction. And unlike the cuts for individuals, which were set to expire after 2025, the corporate cuts were permanent. Locked in. No expiration date. Why the difference? Because of budget reconciliation rules. In order to pass the bill with a simple majority in the Senate, Republicans had to ensure the bill wouldn't increase the deficit beyond a 10-year window. So they gave corporations permanent cuts, and gave individual taxpayers a ticking clock. Let's talk about pass-through entities, businesses like partnerships, S-corporations, and sole proprietorships. The bill allowed owners of these companies to deduct 20% of their qualified business income. That sounds like a small business benefit. But in reality, the lion's share of that deduction went to high-income professionals, think doctors, lawyers, investors, and hedge fund managers. A 2018 report from the Tax Policy Center found that 53% of the benefits from the pass-through deduction would go to the top 1% of earners. Then there's the estate tax, often called the death tax by its opponents. Before the TCJA, the estate tax only applied to estates worth more than $5.5 million for individuals, or $11 million for married couples. That meant only a tiny fraction of Americans were subject to it. But the bill doubled the exemption, raising it to over $11 million for individuals, and over $22 million for couples. By 2025, that number had climbed even higher due to inflation adjustments. So who benefited? Billionaires. Wealthy families. Political donors. Not your average American household. And then there's the change to SALT deductions, state and local tax write-offs. Before the bill, taxpayers could deduct the full amount of their state and local taxes on their federal returns. That helped residents of high-tax states like New York, California, and New Jersey. But the TCJA capped the SALT deduction at $10,000. This disproportionately hurt upper-middle-class households in blue states, while redistributing more tax relief to lower-tax red states. It was a political maneuver, disguised as reform. And the alternative minimum tax, which was designed to ensure that the ultra-wealthy couldn't avoid taxes entirely, was weakened for individuals, and eliminated entirely for corporations. Let that sink in. Corporations now no longer have to calculate a minimum tax owed, no matter how many deductions they use or how profitable they are. The bill also allowed immediate expensing of capital investments, meaning corporations could write off the full cost of equipment purchases up front instead of depreciating them over time. That's a massive boon for companies sitting on piles of cash. All of this, combined, added up to an estimated $1.9 trillion in lost revenue over 10 years. Proponents argued that economic growth would offset that loss. But the data doesn't support it. According to the Nonpartisan Congressional Research Service, the TCJA had little measurable effect on wages or investment. Corporate stock buybacks surged. CEO pay spiked. But the promised boom in worker salaries never materialized. By 2020, corporations had spent more than $1 trillion on stock buybacks, rewarding shareholders and executives, not rank and file workers. Meanwhile, working Americans saw small tax savings, temporary in nature, that would vanish in just a few years. And unless Congress takes action, Many of those benefits will sunset in 2026, leaving most households with higher taxes than before. This was the reality inside the Big Beautiful Bill, not a middle-class miracle, not a job creator, but a carefully engineered windfall for the already wealthy, dressed up in patriotic slogans and signed with a smile. In Part 3, we'll examine what happened after the bill became law, the fallout, the real-world consequences, and the growing national debt that lawmakers quietly pinned on working people.